Every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. So what were the loans doing on Friday? Markets were closed yesterday. 30-year conforming loans, 6.518. Jumbo loans, 6.32, up a little bit. FHA, I'm sorry, those down a little bit. The FHA loans, 6.395. Those were up a little bit. The USDA loans, rural areas, generally no down payment, 6.423. That was down a little bit. And the best loan on the market for those that earned it, that would be the VA loan at 6.197. It was up just a little bit. So let's take a look at what the markets are doing right now. We talked about this a little bit in our opening segment. S&P 500 is now down 68 points, 1.67%. Let's see if we can find the 10-year Treasury. I think my computer's going as slow as I am today. So 10-year Treasury is up 7 basis points. Mortgage-backed securities are down 58 basis points. That means interest rates are up once again. Ow! Why? So let's take a look and see what's driving this market. So let's see what we can find here. It always comes down to it. Existing home sales tracks closings on existing homes decreased by 0.7% in January at a 4 million unit annualized pace, which was below the 4.1 million estimate. Supply was up 15.3% from a year ago, and the median existing home price was at $359,000. Remember, that's a national number. Here in Southern California, Northern California, wherever you might be, the numbers are going to be different for your area. It's a 1.3% rise from a year ago at 131 months of consecutive year-over-year increases. This is the longest running streak on record. That's part of the issues. Obviously, we talk about the geopolitical issues that I mentioned in the earlier segment. And leading economic indicators, the Conference Board's Index of Leading Economic Indicators came out for January and fell 0.3%, which is the 10th month of decline in a row. When looking at the 6-month growth rate on an annualized basis, it's down 7.4%. When this number breaks beneath 0%, it's a warning signal. And when it breaks beneath 4%, -4, it's a recession signal that has been extremely accurate historically. Conference Board stated that they believe the U.S. will enter into a recession in 2023. Only 6 times in the past have we seen anything like this, and each time the economy slipped into an official recession. That'd be 1970, 73 to 75, 80 to 82, 1990, 2001, and 2007. Historically, a recession begins on average 13 months after the LEI peaks, and being that it peaked in December 2021, the recession should be upon us or starting soon based on the average. If we do, in fact, see the recession-like conditions, we will see economic activity slow and interest rates will move lower. Again, no guarantees. That's just based on historical issues. Think about that. So rates go down. There's going to be more demand for properties. As there's more demand for properties, we get back to those bidding wars. And again, you get to have trouble trying to find the home you want. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990.